Welcome back. We'll start off with the United States, where the Commerce Department's Consensus Bureau has reported that U.S. retail sales increased by 0.7% in November, exceeding expectations following a revised 0.5% rise in October. The growth, driven by a surge in motor vehicle purchases, indicates robust economic momentum as the year ends. Strong labor market conditions, low layoffs, and high wage growth are supporting consumer spending, while household savings and high asset prices also contribute to the increase. Despite the challenges, like the delayed date of Thanksgiving, retail sales reflect a strong start to the holiday season. In North America, Canada's Finance Minister, Chrystia Freeland, has resigned, citing differences with Prime Minister Justin Trudeau on how to address the economic impact of Donald Trump's tariff warnings. Freeland, who also served as Deputy Prime Minister, expressed concerns over the government's fiscal policies, including recent proposals for direct financial aid amid a growing deficit. In her resignation letter, Freeland emphasized the need for Canada to remain fiscally cautious in the face of potential U.S. tariffs, warning that costly political measures could further strain the economy.
The relationship is balanced and mutually beneficial. How Canada is the largest market for the United States.
Canada's annual inflation rate unexpectedly fell to 1.9% in November, driven by a broad slowdown in prices, with the consumer price index unchanged from October. Travel, tours and mortgage interest costs were the largest contributors to the deceleration. Core inflation measures, CPI median and CPI trim, remained unchanged. The Bank of Canada, which has cut rates by 175 basis points since June, will assess the data before its January rate decision, with markets seeing a 55% chance of another 25 basis point cut. The Canadian dollar paired some losses following the report. Moreover, Canada's fiscal deficit for the year ending March hit 61.9 billion Canadian dollars, surpassing projections by 50%, largely due to pandemic-related and one-off spending. The deficit exceeded the government's original target, with additional expenses related to Indigenous liabilities and COVID-19. Despite managing its debt-to-GDP ratio, Canada still faces a higher deficit-to-GDP ratio and the looming threat of U.S. tariffs under incoming President Donald Trump. The government has revised its 2024-2025 deficit forecast to 48.3 billion Canadian dollars, while the GDP growth for next year is estimated at 1.7%.
But we know that every step of the way, we will be there to support each other.
I understand that there is a tremendous amount of